Good morning, everybody. It's Tuesday, April 16th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to it during the show. Overnight markets here had May corn down 1.5 pennies at 4.30, May soybeans down 3 at 11.55 1/4, and May Chicago wheat was down 5.5 at 5.46 1/4. Yesterday's notebook crush numbers were released. 196.4 million bushels of beans crushed in March there. That was the largest crush on record for any month, which we had anticipated. It was just slightly below estimates, but still a very large number. Looking at yesterday's crop progress report, USDA came out with 6% planted nationally as of Sunday. That compares to 5% on average and 3% from last week. So we're starting to see a little bit of a bump in progress. Most notably, I would say Missouri had a strong jump at 26%, which is up 16% from where they are on average. Guys, good morning. Not a lot in the way of overly fresh news. Market's just a little softer overnight. I know we were talking before the show, Ben. We still continue to see back and forth between Israel and Iran in terms of what if there's going to be any retaliation or what's going to happen over there. And so we're talking just a little bit about what that means for our markets in terms of a risk off or risk on type of mentality. You're muted there, Ben.
I think it's pretty plain at this point that Israel will retaliate, and then Iran will retaliate again, and it depends to what level it escalates. But I think it brings up a good conversation as you see people connect the dots on, what's risk on, what's risk off. There was kind of a lean and a tilt, I think, over the weekend that this would be supportive grains, and I think it's a very difficult connect the dots line when you have an event like this going on and you're trying to turn it into something bullish or bearish. And ultimately it comes down to the short is profitable. It seems to be very comfortable with their position. They will not come to cover until they see something that's threatening to that. And then on the other side, you have the grower still sitting on a fair amount of old crop, although I don't think it's, mathematically in the calendar, it's not what it was 2, 3, 4 months ago. But there still is plenty of corn, especially in the east, and we're getting off to a good planning window with first notice day in front of us. But I think one of the early seeds that gets the market going is volatility, and that will draw in traders. The advent of the electronic markets is people can shift from market to market by clicking on a box, as opposed to the cumbersome way that we did it back when the pits were open. So you see markets like the equities and the bonds that have been pretty volatile. People can jump over there and start trading it. A lot of the methodologies that are used for the day traders, the scalpers, the market profile traders, to them, it doesn't really matter. They just want movement. So you have to have something to incent those people to come and participate and to figure out which way is the path of least resistance. And the greens just don't have any of that right now. It can change, and it can change quickly. You take cotton, for example, which had been a really quiet, dull market for probably 7 months. And they put 25 cents on cotton really, really quick for no other reason than they were short and someone wanted out, and then they gave it back quickly. So I think that connecting those dots to a risk on or a risk off mentality is difficult, especially look at some of the things in the past that we've had. I'm going to bring up 2 examples that were really big events. Fukushima is one that comes to mind. We had a nuclear issue, a nuclear problem. People saw that it was bearish that day. And you go back to Chernobyl in the 80s, and we were limit up for 2 or 3 days in a row. So similar type of events, completely different reactions. And then you can have something for those people who were around a long time ago. When September 11th happened, our markets died for the better part of 4, 5, 6 months. There was nothing going on. People were okay with sitting on the sidelines and doing nothing because there was so much uncertainty. So I think just some respect on what markets can do and not do, and not getting overly convicted in one way or the other based on a geopolitical event. And I think that the grains have to pick up a little more intraday trade, a little more volatility, and we might be able to draw some people away from some of those other markets and start pushing some of the outer limits of our ranges. On the short term, it certainly feels like we're repeating kind of a first notice day event here, slowly grinding out, and we'll see what happens when options go off. So, but it can be a very costly mistake to hitch yourself to a narrative, because you'll tend to lean towards the one you want.
Yeah, that's that's good stuff. Justin, anything to add to that?
No, I agree. And we talked about this over the years, trying to, as a trader, trade the market you have, not the one you want. And it's really, it's so true. It's, you want corn to go up, or you want beans to have a rally, whatever it may be. Just not the reality right now. I mean, it can, like you said, things can change quick. We are just getting into the growing season. We're, 5% planted. So it feels like it's been a long growing season already, but we're just starting. So there's this, markets kind of, my opinion, try to kind of carve out a, kind of bottom, and we've had a decent rally, and that's being sold by, by the farmer. We've had some friendly reports. We're doing good crush demand. We've got some, pretty good corn export programs going on, sort of some positive and negatives. And we've talked about this a few times where, maybe we found some kind of a balance, but that just, might mean that we're in a kind of sideways, frustrating market, where we have good rallies that look like it should be sustained, and then it kind of fails and falls apart, and then it finds some support. And we're really just been trading around these moving averages and just trying to get something going in the grains, and just nothing to take us right now that next leg higher or lower from what I see. Now, maybe we get planted, we're getting some rains in dry areas, and the worst case scenario would be what Dustin outlined, where you have a 2017 type scenario where you only had a 10% rally from the bottom, and then it kind of goes sideways into the weather's too good, or it just kind of drifts lower. So that's obviously the worst case scenario. Structurally, it feels like we're still trapped where the market doesn't want to rally too high to give the farmer a no-brainer sale. That their margins are tight, and there's a lot of selling above the market. But at the same time, there's not a huge incentive to sell, because you are negative margins for a lot of people. So it's a really just my opinion, it's a really, really tough environment. And I don't know how you get out of that until something new happens.
Yeah. I was
Debbie Downer. That's just kind of the situation we're in right now.
I was thinking about this yesterday, and this is certainly looking a little forward, and again, going counter to what I just mentioned, which is trying to connect the dots to a narrative. But until, we may have any sort of difficulty getting something going until we get through even July expiration. And I know that's late in the season. The typical mantra this year from a lot of people, if you listen to Talking Heads, is, well, it's going to be a May, June type of event, and you better have this done and that done. We may actually need to have the final purge of old crop before we can get something going on it. That did happen in 16, I think, was we had a really late, a July rally, and it didn't last long, but was similar. It was a, oversupplied market. And once we got past that first notice day break thing really kind of fell on its face, and we shot up, and then it was over after that. So I just kind of thinking out loud.
Well, we were talking yesterday after the close, and I'd gotten a question from a banker, just what percent we thought farmer had finally sold on old crop. And we knew, we've talked about a long time, the industry's talked about, how far behind normal we were going into the, beginning of the year. And, like you said, Ben, like just mathematically with the calendar winding down, how much corn we're using, over 1 billion a month, that naturally that number does go down. What's interesting is the amount of, there are different terms that different elevators use or regions use, but, basically, where the farmer delivers the corn to the elevator buys a futures contract so that they still can price it at a later date. But the end user's using that bushel, right? So the farmer's just long on paper in that situation, right? Which can be ultimately really bearish. So even though you are using 1 billion bushels a month, it might not be priced in a lot of scenarios, where they've replaced a physical long with a paper long at the delivery location. The delivery location, there's obviously there's different variations of this where it's just commercial storage, but either way, it's being used in a lot of scenarios, and the farmer is just long on the board. So that could be why we see some, the commercial long continue to stay long. We're not seeing that change in ownership on that commitment of traders like we would expect. It could be that there's just a larger amount of just unwilling farmers that are unwilling pricers, but they have to move bushels because they're getting ready for planting or logistic reasons or storage reasons or keeping quality, whatever the case may be. But that could be to your point, just an overhang on the market until those contracts, we work through them.
Yeah, and just thinking through that a little bit deeper, the last time we had a net commercial position around this area was 2019, and that was the last time funds were extremely short. So in theory, let's say the funds have pushed markets lower than they otherwise would have been. 2019 was another year of that prior to the wet spring that we had and wet early summer. But just assuming that they've pushed prices quite a bit lower than our 2-3 year averages, and I think everyone would agree that prices from the producer side are not not desirable right now. But from the buy side, they may be. So you may have have stirred some interest to go get cattle crush, ethanol crush, forward crush, all of this on paper, and that's where all the buy side has come from. And you also have the grower that's kind of waiting for that rebound to sell, and whether they've already delivered that bushel or not for logistical reasons, they might have it on DP or on basis only contracts, like the different terminology Justin's talking about, where that long future contract still is in their name. The real problem with this whole situation is when you have really, really wide carries, funds might not have a catalyst to get out of that position. They might continue to roll for years if they want to. And yet the grower, especially if these bushels are primarily held at the delivery point, they still have to sell. Buyers have already bought, right? I'm overgeneralizing this, but they eventually run out of time because the commercial will not allow that to be rolled past the September contract. So that's a lot of times we see a seasonal weakness right there at the end of August. A lot of it could really be associated to that's just the end of the line. There are no more rolling of basis only or DP because that goes into another crop year and it violates the whole contract type of what the commercial is allowed to do in many cases, depending on the location.
Yeah, right. So I mean, just look at that. Like that's that's like when you look at options expiration or you see really big open interest somewhere. We've seen it in the past with other contracts like accumulators, right? Where you hit those knockouts or the market kind of targets, on purpose or just, the invisible hand, if you will, just where order flow tends to naturally go. And, you could see something, if you were to see some event that did trigger short covering, you could quickly run from that type of situation, in my opinion, into another accumulator type problem where I think there's a ton of double ups, people are exchanging certainty for, they're any kind of way to get a premium towards what looks like maybe a break even. You could quickly run in this, especially a low, volatility, option volatility environment where if there was a sharp move, like cotton that Ben brought up, we rallied 25% in 2 months and then we broke 20% in 2 months. Right. So in that situation, you could quickly, run into where there's too many shorts, not that far above the market also. So especially when these markets kind of get dull and sideways and people feel like they're forced to trade or put positions on, that's where you could have a quick type, jolt to the market if something were to happen. So just to be kind of, look at the other side of the coin here. But ultimately there is that position at the end, right? So that's maybe like, if you think about, you look back at, 16, 17, 18, even 19, when we had a, 100-year floods and we lost 19 million acres. Those rallies were super sharp, super fast, and then over really quick. We weren't in, it took 2020 to 2022 where we had a sustained 2-year rally. And I just don't think that's necessarily the environment we're in. that was kind of coming out of COVID, and a lot of things were kind of going our direction to have that sustained big bull market. So I think these might be quicker. And I mean, look at the report that we just had. The acreage report, it was a 1 day, 2 day thing. And then that was kind of it.
And it really, I think from on paper, I'm not going to say it was bullish, but it was pretty supportive. And we're sitting right at where we were going into the report. So, that's in the rearview mirror now. I think we get to May and, we look at that report and there's nothing that's going to be eye popping from a corn perspective other than the conversation of, well, we've never made a trend line yield of 181.5, right? That's I think your variable for the next 6 to 10 weeks.
Which could be, I mean, those are years too where, market just sucks going into June, July, where the market feels like it wants to make the crop. And then that's where the surprise could come. I mean, it could be an early harvest low too. So I've seen that where, market just assumes all bearish factors. I mean, that's what happened in 2020, right? People were just knocking themselves down to sell 2 or 3 years of corn at 350 to 380, because there was no hope in sight. So it's a tough one. There's no easy answer here.
Yeah, that's right. Quickly here, Ryland, I looked at some stuff here overnight. Chinese pork production declined in the first quarter for the first time in 4 years. And I know they've been on a kind of a domestic price supporting program for hogs, but what's your thoughts there? And I guess in the livestock in general?
Yeah, I mean, it's definitely a little bit interesting, but I think the market was kind of expecting it. There's been a lot of controls to keep output kind of down, or at least reduce their breeding capacity, just to really help support the price. I mean, that is definitely the incentive right now from what it looks like. I mean, their herd size was down about 5% from at the end of March. So they still got 408.5 million heads. So it seems like a large change, but I think they're kind of trying to move in that direction overall. I think that's a lot of incentive, especially from the speculative side, for our prices to kind of keep a more natural long position in the market. So, I mean, it's just that kind of time of year too, where we see typically demand start to rise at this point. Grills are going to get fired up. I mean, the weather looks temperature wise to be seasonally above normal. So kind of think that we got a little bit of early onset demand to kind of help things out a little bit. We're seeing that in some specific cuts. Bellies were back up $20 yesterday, almost $20. So helping a support cut out there. And just overall kind of seems like that's going to be something to watch. I mean, especially just, if Chinese prices start to explode in the next couple of years, this could be, a pretty big level of support, especially if they're trying to kind of restrict their output and their supply over the next few years. So we'll see what this means. I don't want to put a ton of stock into it right now, just because, it is Chinese data that's publicly released. I think you got to take it a little bit with a grain of salt, but at this point, they're really just trying to deal with their kind of overpopulation of hogs. So I think it's still something to watch. But on our markets, I just think that in general, we've kind of seen this big slide the past couple of days. As Ben was saying, it kind of felt like a risk-off situation, but hard to really tell. But we would see open interest dropping about 4,500 in commitment over yesterday's trade. So kind of feels like you got the longs starting to get a little bit nervous, I think, at these levels, just from the slaughter rates that we're seeing and just from overall the kind of high price that we're seeing at this time of year. Otherwise, we got a cattle on feed report on Friday, and market's looking for on feed at 102, placements at 92, and marketing's at 89%. So we'll see. That's kind of the early stage in the analysts' predictions. So we'll probably have some updates on that through the week, but no cash trade at this point. It just kind of feels like cattle markets dealing with kind of these bearish seasonal time frames. So I think there's still quite a bit of risk here. We're trying to consolidate a little bit, I think, in the near term, but overall, there's definitely some risk over the next month for lower prices.
All right, thanks for that update. Just came into the open here. We got May corn down 2 1/4, 429 1/4. May soybeans down 4 at 11.54 and a quarter, and May Chicago wheat's down 6.5 at 5.45 and a quarter. Every day that the markets are open, we're streaming live on X, Facebook Live, and YouTube Live, 8:15 Central Time. Appreciate everybody's thoughts and comments here this morning. It was another good discussion. So hope everybody has a good day today, and we look forward to talking to you tomorrow.
Thanks, Dan.